Taiwanese index is down around 70 points.
I do think there's a risk that the January CPI will come in higher than expectations.
Adani Ports and Ambuja Cements have moved out of the ASM framework, which means that the additional margin requirements have now come down.
The market's opened and it's absolutely flat for now.
I would say India has turned out to be kind of a mixed bag with sort of a negative bias in this last quarter.
Revenues came in at 5,400 crore rupees versus 46-43 crore rupees.
We continue to see tremendous strength in the new launches that we've had over the past year or so.
The cost reduction efforts, according to them, were inadequate by the company.
We're currently down close to about 0.5%. The Nifty's at that 17,781.
NII was up 13.5% year-on-year, but it was down 2.1% Q-on-Q.
We have an exposure of US dollar 300 million facility that was granted for the Adani Group's Carmichael facility in Australia.
2021-22 में हमने अब तक के रिकॉर्ड 1.5 बिलियन डॉलर से ज्यादा के एक्सपोर्ट को उस आंकड़ों को हमने पार कर लिया है.
The markets, they continue to be lower, but there has been substantial recovery from the lows as well. 50 points from the lows of the day.
Well, that was a day so far. You're with us here on a new edition of Closing Bell. We are coming to you from the CNBC-TV18 News studios. I'm Prashant. With me, my colleague Rima here in the studios, and Surabhi is joining us from the newsroom floor. Guys, hi, good afternoon. It is a red screen, right? I mean, through the course of the day, from the word go today, there has been little but selling and red. Occasional bounces, as I think we've all come to get used to, but really not leading anywhere in terms of a strong pullback or anything of that sort. Four stocks largely are responsible for actually almost all of the losses. It's TCS, Infosys, Reliance and State Bank of India. So you take these four out, the picture looks very, very different. All sectoral indices, the last I checked, were in the red, but PSU banks and IT services were some of the top losers. And small cap and mid cap indices are down. They're down about 1%, 1.5% in that range. Global cues are adverse. I mean, dollar is higher, yields shot up, oil prices are up, equities are down. So it's not exactly the cocktail that you would want. And of course, later tomorrow night we get the US CPI number, which potentially has the ability to change things around. But as of now, I mean, the global environment is not very supportive, something we've been highlighting from the word go this morning as well. So, I mean, it's a 80-odd point cut, not even 0.5%. But for the broader market, I think the damage seems a little more severe. Rima, hi.
Hi, Prashant. So in the first 45 minutes, we had that big fall. Markets opened in the green and then it fell. But after that, from 10 a.m. to about 2:30 p.m., the markets have actually moved in a very tight band of 50 to 70 odd points on the index level. Today, we've seen a lot of underperformance in the broader market. So while the mid-cap index is down 1.5%, the small-cap index is lower by more than 1%. The advanced decline ratio has got 2 stocks in the green for 5 in the red. Look at the way some of these earnings misses have come in for selling pressure. The sell-off is sharp and Balakrishna Industries is down 11%. Info Edge is down 9.5%. We'll discuss these stocks in greater details. But City Union Bank, these stocks are not getting spared. 16% down on City Union Bank. The Adani Group stocks once again have come in for selling pressure. Adani Enterprises is now lower by 7.5%. Stack up the cues. After markets close for trade today, you've got the India CPI inflation print at 5:30 p.m. And tomorrow is going to be a big day in terms of earnings. So from the frontline pack, Adani Enterprises, Apollo Hospitals, Eicher Motor, ONGC. So four benchmark, Nifty companies report their numbers. And on the mid-cap end of trade, you've got Bata, Bharat Forge, Biocon, Bosch, Vodafone Idea, IPCA, NMDC, PI, Siemens, Torrent Power. So a lot of companies will be reporting numbers tomorrow. So it's going to be a very crucial day. Surabhi, what are you looking at?
All right, folks, I'm trying to pick out some green, some positivity on an otherwise very dull and red sort of a Monday afternoon. I was actually looking at some of the new age companies. And interestingly, I completely take everything that you said on board, Prashant and Rima. It's just that I was looking for some specks of green. So your Paytm, Delivery, PB Fintech, some of these stocks which are showing some hint, hope and promise of moving to profitability. That's where the buying is concentrated in an otherwise very, very weak environment. And we'll, of course, talk more about City Union Bank, but that's a case in point where there's absolutely no scope for any sort of disappointment or misses. Huge punishment to that stock, 16-17% down on City Union. But Prashant, completely take your point, and I was looking at the yield myself. I mean, the US 10-year is pushing almost 3.75 now. There's been no let-up. The dollar is also very, very firm, very much above that 103.5 sort of handle. And futures on Wall Street are down. European markets are holding up, but Wall Street futures are still looking very, very tentative. So, yeah, take your point that the global setup isn't supportive, at least as of now.
Let's now move on to tell our viewers what we've lined up on Closing Bell today. Balkrishna Industries slumps in the back of a weak set of Q3 numbers. We'll get you key management takeaways from their conference call. InfoEdge is also under immense pressure as the company feels the pinch of slack IT hiring and a startup funding winter. Adani Group stocks continue to see selling pressure even as State Bank of India clarifies to CNBC-TV18 that more shares were sought to meet the mark-to-market slips on existing loans, and there has been no communication from the group for new loans. Excerpts from our conversation with SBI MD coming up on the show. City Union Bank tanks following a weak set of Q3 earnings. We'll be joined by the management to discuss the way forward. And we've also got our Alpha manager for the day, Aman Chauhan of Abacus Asset Management, later on the show.
Okay, well, how should you position yourself with the cut that we have on our hands? In terms of stocks, what trades to take? Mitesh is with us as always. Mitesh, what should one do? Is this the break you're looking for? Because, from the last we spoke a little after 10 in the morning, it's not as if incrementally anything is, at least on an index level, we've built on, right? We're right there.
That's right. Prashant, 17,700 was the breakdown level. We kind of hit 17,720 and managed to at least give a weakish kind of a bounce back, but we haven't broken that. So I think we're still in that wait and watch mode because the index is still not showing signs of a follow through happening on a directional basis. So you got to be, not trading the index in that sense that you will not get any kind of significant directional movement happening. So for the time being, either it breaks 17,700 or I think we'll head towards 17,900, 950 zones again on the upside. So still contracting, still sideways. Therefore, stock specific trading is the way to go. And ONGC is something, I remember Sudarshan pointing this out, this stock out in the morning. It's just come on my radar as well. So ONGC is something which I would recommend a buy with the stop at about 146 for targets of around 154 to begin with, and then maybe even higher levels. And Power Grid is also showing good traction on the intraday hourly and 2 hourly charts. So that's a buy with the stop at 213 for targets of 224.
ONGC reports numbers tomorrow. Mitesh, thank you very much for those trading ideas. Let's talk a bit about Balkrishna Industries. The stock is slumped on the back of a very weak set of Q3 numbers. Their profits were down 70%. They held a conference call earlier today, and Sonia joins in with the key management takeaways. Sonia, before that, what explains this kind of weak performance? Because the rest of the tyre companies, whether it's JK Tyres, SEAT or Apollo Tyres, had a fairly stable quarter. So what explains the weakness that Balkrishna Industries has seen?
So as you rightly pointed out, the numbers were very weak this time around. And if you look at the EBITDA performance, EBITDA was down in double digits. A 17% fall is what we saw. The margins have fallen substantially, 19% versus almost 25%. Now, the management in their presentation said that there is inventory destocking that they've seen. Also, the situation across the globe is very challenging. Remember, Balkrishna Industries operates in the farm equipment segment globally in terms of agricultural tires, etc. They do off-highway tires as well. And that pocket globally has faced a lot of pressure, especially in markets like Europe. And hence, their numbers have been, under pressure. Now, in the conference call, they said that they expect the inventory destocking to continue in coming quarters. There is huge amount of finished stock currently lying, at the dealer's end. The finished goods stock is currently at 2.5 months versus an average of around 40 to about 60 odd days. They expect the benefits of raw material inventory correction to flow in partially in Q4 and fully by Q1 of FY24. And they say that the benefits of lower input costs and freight will be at least 300 basis points. So that's a positive, but that will happen from Q1 of FY24. However, the problem really is in Europe, and over there the agricultural tire business has been under a lot of pressure. They are saying that given recessionary trends, they expect a low single-digit volume growth in the near term in Europe. They are still sitting on a debt of around 1,350 crores, so there's balance sheet pressure as well. And their guidance for FY24 in terms of capex stands at around 300 to 400 odd crores. So all in all, you'd have to say that large amount of inventory along with the recessionary trends in the global markets, especially in what's happening in Europe, is something that has spooked the stock. And, that is the expectation that the company has in Q4 as well. So perhaps hence no recovery coming through even post the conference call. Back to you.
Okay, got that, Sonia. Thanks very much for explaining some of the reasons there that have led to this sort of a price move on Balakrishna today. Let's take the conversation to Hemang Jani. He's from Motilal Oswal Financial Services and is with us on this leg of the show. Hemang, good afternoon. Thanks for being with us. So that question first, really, I mean, Sonia explained why the street is a bit distressed because this seems to be a problem not just for Q3, but probably will linger. Would you at all be an optimist and try and use the dip to buy, or would you stay away till things get better?
Good afternoon, Surbi. I think this has been one of the better performing tire stocks in terms of the stock price. And clearly this quarterly performance has come as a major negative surprise. And as Sonia also pointed out, that the challenges of the destocking will remain in Q4. But having seen such a sharp cut in the stock, and the fact that management also has guided that the lower raw material and the freight cost and a better hedge would start reflecting from the Q1 of the next year. I think that means that, at some point we have to start nibbling into this kind of a company, because, it has been the best performing tire stock in the, in the entire, this year. And another maybe 5 to 7% cut would make it a little more attractive from a risk reward perspective.
Okay, that's about Balakrishna Industries. Keep your eye on InfoEdge. That's the other big drag in trade today. Our stock currently is down 9.5%. Now, InfoEdge, remember, is a combination of the Naukri business, the recruitment business, but they also have other verticals like real estate, matrimony, which sells under the brand of Jeevan Sati, and Shiksha, which is the education portal. Now, this time, the miss for InfoEdge is that revenue growth has slowed down. So this quarter, the company's clocked in at 33.5% year-on-year revenue growth. But the revenue run rate was more than 50% for the last 4 quarters. So the revenue growth rate has slowed down. And the key reason for that is that the IT business, the IT hiring, which used to contribute about 50% to their overall revenues, has seen a substantial reduction or a slowdown. EBITDA margins on the flip side have managed to improve. So EBITDA margins at 39% is the best that we've seen in the last 21 quarters and practically at an all-time high level. And one of the reasons for that is the company has curtailed its advertising spend. On the bottom line, there is a big loss of 84 crore, and that's due to an exceptional charge or a loss of 276 crore. The company makes investments in various companies and startups. One of the startups they had invested in was called 4B Networks. It was started by the Housing.com's ex-founder, Rahul, and he had started 4B Network, which is a real estate portal. But unlike 99 Acres, which helps consumers reach out to projects, real estate projects, so it was a B2C platform, 4B Networks was a B2B platform. It connected developers, real estate builders with the brokers. And according to InfoEdge, 4B Networks was struggling to raise some money, external funding, and that's the reason why they've taken that big impairment charge of 276 crore, which has resulted in the company reporting a loss. The fear is that there is a risk of such similar write-offs in other investee companies. Though as of now, the company has clarified there is no case, but the market is a bit worried about that. Hemang Jani is with us now. Hemang, your thoughts on InfoEdge? This is a company where valuations have also been on the richer side. What have you made of the numbers, the double whammy of IT hiring slowing down and the risk of the startup winter and the funding crunch that startup companies are seeing, which could hurt their investment portfolio?
So, Rima, the numbers were pretty much in line, but I think the IT hiring was down about 25% and the overall hiring was up 2%. So the near-term growth in the recruitment is expected to be adversely impacted by the lower IT demand. And we think that because the non-IT demand continues to be good, there is a scope of a 16% kind of a revenue growth from 23 to 25. And management has been investing very prudently. Some of the investments that they have done should help them scale up from medium to long-term perspective. So I think this cut of 10% clearly reflects that weak undertone towards IT sector. And at the moment, we are staying away from this name. We have a neutral rating.
Okay, neutral rating. Hemang, what are you doing? I mean, in terms of picking up stocks, where is the focus really at this point in time? Or are you preserving cash? Do you expect more downside?
So Prashant, clearly, banking has been one space where the performances, have been good. The stocks have corrected, and we have been liking, that space for a while. Apart from that, I think IT, because of the kind of uptick that we had seen in US, there was some revival, and the large cap, companies do provide a good entry point. And apart from that, I think you can look at some of the ideas in the auto ancillary space. So yes, the market has been a bit difficult for past few sessions because of the volatility and the news flow around Adani Group, but we look that as a buying opportunity in select spaces where the numbers have been good, where there are some upgrades.
Okay, just got those numbers from Heidelberg Cement. The margin has completely collapsed. Stocks under pressure. The rest of the market is trying to sort of fight back to some extent. Now we are down just about 0.3%. There's a bit of a fight back underway. Let's take a break. We'll come back and continue the conversation with Hemang Jani and also get you more on the markets. Also, we will be chatting with our Alpha Manager of the day, Aman Chauhan of Abacus Asset Management, will join in.
Welcome back. Delivery is a stock which is on my radar because there has been a substantial intraday recovery. Now, Delivery opened below 300 rupees. That was the opening level on Delivery. This compared with the closing price of 315 yesterday. So straight away at open, the stock was down nearly about 5%. But intraday, you've seen that buying coming through in Delivery from the day's low. It's recovered close to about 7.5% now and is back in the green now. Remember, came out with their numbers. On the top line, very muted. Revenues were down 9% year on year. On a quarter-on-quarter basis, revenues were only up 1.5%. So there was clear weakness in demand seen at the top line. What the street is latching on to is the fact that on a quarter-on-quarter basis, the profitability or the losses are reducing. So at the bottom line, this quarter, the company reported a loss of 195 crore, but it compares with a loss of 250 crore in the September quarter. So demand is weak. That's hurting the top line. But at least at the profitability level, sequentially, there has been that bit of an improvement. Nykaa, on the other hand, has slipped to the low point of the day. Nykaa reports their numbers later, usually post-market us, so we'll be tracking that very closely and what they have to say about the margin performance from here on. But another group of stocks that we've been looking at, they've been in the spotlight now for nearly a fortnight, are the Adani Group stocks. And today, they continue to see selling pressure. This is even as State Bank of India has clarified to CNBC-TV18 that more shares were sought to meet the mark-to-market slips on their existing loans, and there has been no communication from the group for new loans. Listen in to an excerpt from our conversation with J. Swaminathan, the MD of State Bank of India.
We have an exposure of US dollar 300 million facility that was granted for the Adani Group's Carmichael facility in Australia. Of which they have drawn down USD 180 million towards the railroad part of the project, while the mines they have so far managed to complete with their own resources. So there is one of the covenants for this facility is that they should maintain 140% collateral coverage in addition to the project assets. they are required to maintain this collateral coverage by way of pledge of shares from the three companies belonging to the group. This is not any loans that was granted against pledge of shares. No additional finance was granted against this additional pledge. These are essentially to maintain a covenant that is pre-existing in terms of an earlier facility, which is completely covered both by project assets as well as this collateral coverage.
Okay, so that was the SBI management clarifying the exact nature of those pledges, and some very important comments coming in there from the SBI MD. Hemang, your thoughts on the issue at large over here, and then of course a specific call on State Bank of India. But what is your take on the manner in which the disclosures are right now being made by a lot of the banks, by the sort of explanation that SBI did provide to assuage some of these concerns around the debt of the group?
I think, Surbhi, the overall exposure of Adani Group to the domestic banking sector is not very large, about $7 billion, and most of the banks have already disclosed, be it State Bank of India, IndusInd Bank, and maybe a couple of other banks. So, in the overall scheme of things, we do not see this as a major negative. But given the kind of media attention that this entire episode has got, and the kind of volatility which we are seeing in certain stocks, that will have some bearing on the banking stocks. And we think that particularly PSU banks, where the exposure is on a higher side, could go through a little bit of more volatility. But overall, we continue to have a positive bias on names like State Bank of India or Bank of Baroda, because their numbers have been good, and we do not see this as a major negative issue for the banking sector.
Remember, tomorrow we get Adani Enterprises numbers, right? And but most others have reported. I mean, and the numbers came through from all of these companies by Friday. I think we had all of them, and there are 3 or 4 common threads. One, of course, is the fact that numbers broadly are in line, right? In line, or there has not been any big miss or anything of that sort at all. Second, of course, is this banking bit, right? We now have information from lots of banks, etc. Broadly, it's estimated that the total exposure is about 1% of loans outstanding in the banking system per se. And one more interesting thing rather, that most companies have cut their what they said they will do in capex, not the committed capex, but in terms of what they brought out plans
internal
overall.
Thinking was on capex.
Yeah, I think that has been brought low. Maybe not that sort of bad a thing at all. So I mean, I think maybe slowly there was this Moody's thing, of course, which came through on Friday market hours. Perhaps that is at the margin putting some pressure. But I think generally there is recognition that whatever issue there may be, it perhaps is at the whatever it is at the promoter level, but at asset level, perhaps it's not. I mean, it's not that bad, or these are all cash generating assets, etc. And if loans are tied to these individual assets, as in the case of most infrastructure, etc., is, I mean, it's no reason to panic or worry. Of course, sometimes things do get out of control and become a bit of a spiral. Maybe we're in the midst of one of those. We will see. But for now, you are seeing some selling pressure. Stocks all have bounced from the day's low even today. They started even lower, but they're still more down than up at this point in time. The other stock we want to focus on is Lupin, which is under pressure. Brokerages remain pessimistic over the company's ability to meet their margin guidance. Ekta is here with more details. The stock started sharply down, and I think it's right there at the day's low, 8% lower. Ekta, over to you.
Thanks for that. Well, yes, definitely a tough quarter for Lupin. In fact, they held their call on Friday, which was post-markets, and now they are reacting to the management commentary as well as the brokerage disappointment largely. A couple of key points from the brokerages, a couple of them include the fact that the cost reduction efforts by the company has been inadequate. The margin has fallen short of the trajectory to achieve 16 to 17% by FY24. Guidance was to reduce cost by 500 to 600 crores, which they had guided 2 quarters ago. Instead, there was a cost escalation which has taken place as of 9 months. The concerns is that they will not probably be able to hit margins of 20% by Q4 or FY25 without Spiriva generic. And the EBITDA is probably going to be similar in Q4 as it was in Q3. Now, for Spiriva generic, it's an important inhalation product in their pipeline. It is expected to be critical in terms of growth. That too has been delayed to the first half of FY24 versus FY23. the street is factoring in at least 26 to 29% in terms of core earnings from FY24 to FY27 from this particular product. So there are a lot of variables with regards to that, whether or not it will see the light of day as per the timeline provided by the company. Bernstein market performed, target price 572 according to them. The numbers disappointed. Incred improvement is below the asking rate according to them. Maintain a hold, target price 759. Nirmal Bang has downgraded the stock to sell. Jefferies has an underperform with a target price which is cut. Morgan Stanley has an equal weight.
Okay, got that. Thanks, Ekta, very much for all the details over there. With that, it is time for our special segment, D Street Chatter. And of course, we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. And Nimesh is right here with me in the newsroom. Nimesh, so it's been a range-bound day. It looked like the market was suddenly developing momentum on the downside in the afternoon. Then we kind of stabilized. What's the word out there?
You know, again, we are at day's low, so to speak. Just a small recovery wouldn't matter much, but the breadth is weak. That's been the pain point. You know, the mid-cap and small caps are under more pressure than the large cap stocks. In fact, I understand the institutional activities on the higher side, but the flows are mixed. So the sell-off is not led by very large institutional selling. That's the overall feedback. There's going to be a small market at close basket selling in some select stocks. That might have an impact in the last 30 minutes of trade. But I guess the bigger takeaway from today's market is the fact that you know, the way some of the stocks got reacted to the earnings, that shows that the room for disappointment is very, very low. Very high, precisely very zero. And you've seen sharp reaction. In fact, on good numbers, the stock's not reacting on the upside, you know. That actually shows the kind of sentiment which is there in the market, and that's playing out in many of the stocks. Technically, I think now 17,700 to 17,800 is a very crucial level as far as support is concerned for the Nifty. If that gets taken out, maybe you'll see further sell-off. You know, that's something to watch out for. But broadly, the institutional activity is on the higher side. But today's sell-off is not led by large selling from the larger FIs.
Got that. Okay, let's come down to stocks. And I know you have some very interesting names today on your list. There's Coforge, we've been talking about the deal. And also, I think Titan. That's the one sparkling stock right from the morning. So tell us everything you're picking up.
Okay, so first on Coforge, whether the stock is down 7-odd%, 8-odd%, and we all know that large seller is likely to be, you know, the promoter, which is Barings Private Equity. Remember, they've been a big seller, and we've been highlighting as well for the last few weeks that maybe there is a large block coming, which is going to come soon. Now, what is interesting is after today's block, I understand this will trigger a higher free float, which means both on FTSE and on MSCI, the weight will go up, and that announcement could come in the next few days. So while the stock is down in today's state, that's the fresh thing on Coforge that one needs to watch out for, that the weight will go up both in MSCI as well as in FTSE. The second stock is Hindustan Aeronautics, HAL. While the markets are down, that stock is buzzing in trade today and on good volumes as well, and I believe there is good amount of interest as well at some select FI desks. So today's move is on back of FI buying, so the delivery volumes are expected to be quite high in Hindustan Aeronautics. The third stock is Titan. Again, buzzing in trade, good 2% up in today's weak market. Again, on back of good strong flows. Also, there was a note from Goldman Sachs today. They've added Titan to their high conviction buy list. They have a buy rating on the stock, but now they've added the stock to the conviction list, and that stock is buzzing in trade. And the last stock is L&T. Again, in a weak market, that stock is up 2%. I think in L&T, it's not about large buying interest, but lack of selling from larger FIs. There has been a constant selling in L&T post numbers, but that seems to be absorbed now. And even with the small buying today, the stock is up 2%. So that explains the move in L&T as well today.
Nimesh, very, very interesting list as always. Thank you very much for joining in. So you've got Coforge, Titan, L&T, all these stocks that Nimesh is tracking. Get into a break. As we do that, here is a quick programming reminder for all our viewers. In today's edition of Wizards of the Street, Ramesh Damani talks to one of the most sought-after FII. He's been tracking India for the last 3 decades. A rare voice on Indian television, Bill Kennedy of Fidelity Investments talks about his investment philosophy, his meeting with the HDFC management way back in 1994 when he first came to India, the China +1 strategy and the India opportunity, and his core holdings. Catch this interesting exclusive conversation today at 3:30 p.m. only on CNBC TV 18.
Okay, welcome back. 80 points lower, 17,777 is where we are at. Our alpha manager is Aman Chauhan of Abacus Asset Management. He's with us. Aman, good to have you with us here. Thank you very much for your time. It's a pleasure. Aman, is it earnings which is keeping markets kind of constrained? Is it something else? Because there is no real support from earnings upgrades, right? It's far and few in between. Looking at the third quarter earnings, more downgrades than upgrades. How are you looking at things, Aman?
Perfectly. We share the same view that the earnings season has been lackluster. Besides financials, not much of earnings upgrade that we have seen across the board. At the same time, certain sectors like chemicals, consumers, durables, they have seen big, sharp earnings downgrades. So that's the reason. The trigger that the market was waiting for, that earnings would have a positive surprise, and the market starts lacking, and maybe that is also reflecting in the lackluster market that we see today.
Aman, hi, good afternoon, Surabhi here. So, what is your approach? For instance, let me ask you a question on, on mid caps. Of course, you have that fund which specifically looks at emerging companies. Though it's a lot of it is obviously very, very stock specific, but in general, are you seeing a fair amount of value right now on a day like today when, again, mid caps underperforming? Do you have a big shopping list ready? Or do you think, the market will continue to drag and be a bit challenging, even in the mid-cap arena?
Yeah, the shopping list is ready, but at the same time, there is no hurry to implement that shopping list. So we feel that in the near term, there are not enough triggers for the markets to just run away from here. So for the time being, there can be time consolidation, there can be few months where the market remains lackluster, and that can throw up more opportunities and just waiting for that. So while we continue to deploy some of the cash holdings that we have, but it's very gradually that we are doing.
Aman, on earnings and the point that you were making, this time the earnings has been led by the financials. It's just one sector which is contributing to the majority of the earnings growth that we've seen. The rest of the sectors have either faltered or not provided any earnings upgrades. But going ahead, bank earnings could come under pressure as NIMs start getting compressed. In that context, how do you expect the EPS to perform from here on? If the only sector which is doing well for us in terms of contributing to EPS gains doesn't do as well and the rest of the sectors are not firing, what happens to the EPS growth estimates from here on?
It's not just financials. Capital goods have done well. Select other sectors have also done well. But yeah, financials have taken bulk of the, you can say, heavy burden. Now, going ahead, I don't expect NIMs to contract sharply. At the same time, the bigger driving for earnings for financial is the credit cost. And here, the outlook is pretty good. So we have come out of COVID, and as we speak, quarter on quarter, credit costs are coming off, and this trend is expected to continue. For the next few quarters, hence, I don't see any risk to financial earnings. Along with that, I expect IT and pharma, which have been lackluster stock-wise as also from earnings-wise for the last few quarters. In a quarter or so, they will also start to contribute. So overall, I don't think that a double-digit earnings growth in India on Nifty or overall for the corporate India is at risk. Having said that, now one needs to be pretty selective in what they get into. So clearly, where there is earnings headwinds, that sector or stock, it's not going to perform in the near term.
Anything new you've added onto the portfolio, Aman, just to get an idea about how are you, what you have been doing at Abacus?
Sure. So we continue to remain positive in financials, though they have done well over the last 6 to 9 months. This is one segment where the focus is. We are also pretty positive on the domestic growth, especially on the capex side. So EPC companies, infra companies is something that is looking good. Purely from a valuation standpoint, one can look at utilities also. That is one sector that has not performed for multiple quarters now, and valuations there are reasonable. The growth is coming back, so one can selectively look at this sector also. So this is where broadly our focus has been in the past a month or so.
Aman, I just have a follow-up to that. In your growth fund, the Abacus Growth Fund, you do have a lot of financials in all kinds. In the top 10, I think there's ICICI Bank, there's SBI, there's also Aditya Birla Capital. So how are you, what's the approach to financials? Is it more PSUs? Is it, standard, safe private banks? Are you still looking at insurance for that matter, given what's happened in the budget? Just some more color perhaps on how you are selecting financials?
So clearly the preference is private banks versus public sector banks. So that preference stays. Within NBFCs, we would like to stick to the leaders because with that, the NIM compression or the cost of funds is something which they can easily manage. This mid-size and the smaller NBFCs is something that we are not pretty positive upon. Microfinance is one sub-segment within financials that is looking good. From a low base, this sector is seeing very strong growth and credit costs are coming off, and hence we are pretty excited here. Insurance, yeah, like you said, we have some experience on the insurance, and the budget clearly hit all the stocks in the segment. From here on, I think this can be a steady return because the worst of the news is behind us. I don't expect any incremental news. And there is a case that the representation that the insurance sector has done to the finance ministry, if they heed into that and they file a cap that gets removed or increased, then this can be a near-term positive news for this sector. So for insurance, steady move, and within financial, as I mentioned, clearly preference is private versus public.
Aman, we'll leave it at that. Thank you very much for joining in. That's the view coming in from Abacus Asset Management. Some more stocks which are reacting to earnings and doing well. Oil India, that's an F&O stock, up 7.5%. Glenmark Pharma has gained close to about 5.7%. Profits have come in ahead of street expectations, but as Ekta tells us, the company is holding on to its FY23 revenue guidance of 6 to 8%, considering that in 9 months, it's only clocked in a 3.6% revenue growth. The asking rate in Q4 to meet the full year revenue guidance is fairly high. So that's going to be important to track. And another one is Nalco. Nalco is up 3%. Again, an F&O stock, big volumes. It's the margin beat which the street likes. In the case of Nalco, their operational performance has come in better than what the street was anticipating. Mitesh Thakkar is with us. He's going to tell us a few BTST calls. Mitesh, what do you have for us?
So I have one STBT call actually on SBI cards. I think that's gone into some kind of corrective zone. So keep a stop at about 746 and a target of around 730 could be tested for tomorrow. And the other one is STBT call on Steel Authority, which I would recommend taking a short for a overnight kind of position for us with a stop at about 84.5 for targets of around 82.
Okay, thank you very much for that. City Union Bank has slumped 16% on the back of its Q3 numbers. The net interest margins have come in at a 6-quarter low of 6.88%, and slippages have seen a very sharp increase on a quarter-on-quarter basis. The company has also seen weakness in both deposit and the loan growth. To discuss the numbers, we're now joined by N. Kamakodi, the MD and CEO of the bank now. Mr. Kamakodi, afternoon, and thanks so much for joining in. Can we start by talking about the slippages? Your slippages are up 68% on a quarter-on-quarter basis. 439 crore compares with 261 crore. What explains this substantial increase that we've seen in slippages, and what's the run rate for slippages in Q4?
If you had a chance to look into our last 3-4 quarters, our slippages had been between 2.5 to 2.8%, or in terms 250 to 300 crore was the actual slippages we had seen. In fact, we typically used to have during pre-COVID period between 2 to 2.5%, which increased to about 3% during pre-COVID period, and things were moderating. We had a divergence due to RBI inspection, which we communicated to market somewhere in the last week of December. So we had about 259 crores of divergence, which was above 191 crore tolerance limit set. Based on that, like say, whatever we had recognized as NPA in the first 2 quarters and also after recovery, about 140 crores had to be as impact of that. Actually speaking, this is I feel this is one of the reasonably good quarters in the sense that the entire shock we were able to absorb in the single quarters, post which even sequentially the net NPA has reduced and also the coverage ratio has improved. This shock was because of that divergence which we shared during the December. Going forward, things are moderating. We feel we should be having about 2.5 to 2.8% moderating, and almost all other numbers like ROA for 9 months, things have crossed 1.5%, and all numbers whatever we had shared is exactly in line with whatever we had shared in the past with the market.
Okay, Mr. Kamakodi, good afternoon. Surabhi here. Let me just reiterate that. When you said it will all moderate, are you saying that your slippage ratio will go back to 2.5 to 2.8? The market is probably a little worried whether there'll be more divergences. Maybe you'll have to take that absorption like you did this quarter. Could that be a recurring phenomena in the coming quarters as well?
Basically, in our history, this is the second time in the past 7-8 years the divergence has come, which is not a frequent phenomenon, which normally happens. It's an one-off phenomenon. We feel that it would not happen in the future, for which we are working with. So we incrementally almost we have reached the stage of pre-COVID level, and hopefully going forward the incremental slippage ratio should be coming down. Another thing, the recovery from the NPAs have also improved. That's how we had about more than 80 crores recovery happened from the technically written off accounts. And that's what I said, since we had the sufficient wherewithal in the P&L, we were able to make provision for entire slippages and also because of the divergence in one quarter itself. And that's why even as your numbers say, between sequentially, the net NPA numbers have come down and coverage ratios have improved. And overall, the ROA numbers for the 9 months is 1.5. And all numbers are exactly on track compared to whatever we had communicated in the past.
Okay. And now, Mr. Kamakodi, hi, afternoon. When we spoke late December, you said the total credit loss on all of this will be between 25 and 30 crores on the divergence, 259 crores of divergence.
No, 40 crores was the provision suggested. The normally our NPA recovery rate is about 75% of the slippages is what we have shown over a period of time. And the 40 crores was the incremental provision suggested for this divergence, which we have already observed, and also we have observed the entire divergence and still provided for full, and still our net NPA is sequentially lower, and overall ROA for 9 months has once again is back at one pre-COVID level of 1.5% plus.
Okay. Fair enough. Mr. Kamakodi, otherwise is business, I mean, apart from this divergence issue, is business okay? Is it slow? I mean, very briefly, if you can tell us what's happening.
Yeah, basically we expected things to pick up and take the next phase of growth from December and fourth quarter on that front, which is getting postponed by, let's say, particularly on the growth. And still we had 12% growth. Earlier we projected 15 to 18%. Maybe for the year as the whole, it has to be a tad lower. Apart from that, all the parameters and matrices, whatever we have generated, is almost equal to the whatever expectations we had with the market by and large totally. So that's why all our return ratios still the ROAs and ROEs and net interest margins and things like that are almost in the range whatever we have communicated.
Mr. Kamakodi, just that one last quick point on the net interest margin. That's the market's other sort of disappointment, if I could say that. You've reported a decline in margins. It's come down to 3.88, which is lower than your last couple of quarters of average of 4+. Will this be reversed in the coming quarters?
In fact, no. See, we said it will be around, like say, we also had to not to recognize about 36 crores of income from the gold loan, which we had communicated. Apart from that, all other front are by and large on the same line. And the net interest margin for 9 months is 3.97%, and we had shared that our margin will be between 3.85 and 4%, and our numbers are well within that range we had communicated.
Mr. Kamakodi, we'll leave it at that. Thank you very much for joining in. So City Union Bank, the 3 key takeaways are: 1, slippages will moderate in Q4. 2, growth could be slightly less than what they were earlier anticipating. They were guiding for a 15 to 18% growth, but in the first 9 months, they've only done a 12% growth. And net interest margins have moderated, but it's still within the bank's guided band of 3.85 to 4%. The stock is still down 16%. Get into a break, and more market talk is on the other side.
I mean, the market breadth is terrible, almost 2:1 in favor of declines right now. And this is exactly the opposite when we started early on. Sudeep Bandyopadhyay is with us now, chairman of IndiTrade. Sudeep, good to have you with us here as always. Thanks very much. There is clear selling visible. Broader markets actually is the bigger pressure point. Lots of large liquid names under a fair bit of pressure, profit taking in some cases, earnings disappointments. What do you make of the situation, Sudeep? Near to medium term, what's your prognosis? More pressure, more selling here?
Well, there is definitely some concerns in the market. I think the primary concern stems from the fact that there's a feeling that we are still not out of this inflation-related challenges. There may be some shocks as far as inflation numbers are concerned. That's what the market is feeling. That feeling may not be absolutely unwarranted. And if that matures, I think we have something to worry about. Also, I believe that the global investors, which is the FII community, they're still selling. And, the trade where they were selling India and investing in other Asian markets, including China, is still not over. There is still some residual selling going. And on top of all that, I think we are not doing ourselves any favor by, through the corporate earnings, which is not really inspiring. Yes, the financials, sector by and large has done well, but other sectors haven't really done anything great. And that's also putting pressure on market. Combined with all this, I think there is some amount of profit booking is also happening. And, FIIs hold a lot of financials, and that's why probably we are seeing a lot of pressure on the financial space. That's overall taking the market down. We have, of course, the Adani issue also to handle.
Okay. Sudeep, the market's sort of giving an opportunity to those who want to get in and buy. Are you buying? And if yes, any ideas you want to share for this week?
Well, Surabhi, I think I did mention earlier as well. I think I like L&T quite a bit. And, the selling we saw post results in L&T again was an opportunity for buying. Now, remember, one has to have a little bit of a longer time horizon, at least 1 year when you're buying into stocks at this juncture. There's a significant tailwind behind L&T. The performance also has been improving, efficiency is improving, strong order book. And apart from the India business, the West Asia, hydrocarbon capex is happening, so they are getting orders there as well.
Okay, L&T is the pick of the pack. Life insurers up your alley, Sudeep? They are terrible last few years, some signs of life, and then budget comes. All sold off sharply. Although they did see bounces last week. But again, HDFC Life is down, SBI Life, Max, all these under pressure. You like any of them?
Prashant, I do like the sector. In fact, I must admit that I have been advising clients to buy life insurance companies, and I still maintain my view. I think the post-budget, we did see kind of overreaction. Yes, the government is trying to stop arbitrage in multiple areas. And, this is one of the measures which probably will prevent some amount of arbitrage which was there. But now, leaving aside that part, I think fundamentally nothing has changed as far as life insurance sector is concerned. The basic rationale, the under-penetration, and the opportunity staring in the face of life insurance companies in India hasn't changed. So the rationale doesn't change, and the recommendation doesn't change. So from my point of view, SBI Life definitely is a good buy. One can look at HDFC Life also if you have 2-year plus time horizon. They are still in the process of consolidating post the merger with Exide Life.
Sudeep, we'll leave it there. Thank you very much. Quick conversation today, but appreciate your time here as always on CNBC-TV18. The market will end, I think, 90 points lower. 17,765 is where the index will end at. The bank nifty will come up on your screen. That's down about 0.75%. There again, I think closer to the low of the day than to, the high of the day. One way. Large cap losses coming through in names like Adani Enterprises and Adani Ports, top two volume-led losers. There was SBI for company. And of course, then there was Infosys, TCS, and of course, the insurance name HDFC Life, which I just mentioned. So this is the list of losers of the Nifty. Titan, L&T, and NTPC are the three gainers on the index, meaningful gainers on the index in trade. Market breadth was negative, as I said, almost 2:1. So broader market pressure, quite a theme today. Rima.
We had more than 2,000 stocks ending in the green for about 2,000 stocks ending in the red for about 800 stocks ending in the green. Today was marked by very sharp stock reaction to earnings misses. So City Union Bank took it on the chin, 15% lower. Balkrishna Industries, 11.5% down. Info Edge, 9.5% gone on that. Lupin sees selling pressure yet again. Even on Friday, the stock was under pressure. Coforge, we had the large 10% block deal early in the morning where we learned the promoter Bearings has sold some stake. BHEL, the earnings were not bad, but the stock was still down nearly 5%. Z Entertainment reports numbers today post-market hours. The stock sold off ahead of that. On the gaining side, Oil India, Glenmark Pharma, Nalco, these were a few of the spaces where we did see buying interest on the back of numbers. All in all, it's another range-bound session for our markets, but on the way down, the Nifty and the Sensex ending lower by nearly 0.5%, 17,760 on the Nifty, with the Sensex down 250 points. Mid-cap, small-cap indices seeing large selling pressure. Mid-cap index down 1.5%, and sectorally, it's the Nifty PSU Banking Index and the IT Index. These two sectors led the losses on the way down. Post-market hours, watch out for the India CPI inflation print, will come out at 5:30 p.m. and it leads into the US CPI inflation print, which will come out tomorrow post-market hours, and lots of earnings in the between these two events. Don't go anywhere. On the other side, our Monday special, Wizards of the Street, comes up next.